Record, share screen, present. All right, go ahead, Dakota.
Okay. Case 2, Coca-Cola versus Pepsi financial statements compared. We compared the income statement for Coca-Cola and Pepsi and did a common size of their income statements. What we found was that Pepsi sales are higher than Coca-Cola's, over 100% larger, and Pepsi's gross profit has increased year over year, while Coca-Cola's has been inconsistent. But while Pepsi is paying a higher dividend per share than Coca-Cola, their common dividends are lower than Coca-Cola's. And well, Pepsi's earnings have been decreasing over the last 3 years. Coca-Cola's are inconsistent, and so we don't know what the future holds for them. Their Coca-Cola has lower expenses than Pepsi, but also lower revenue, and we think that this gives investors plenty of choice between a larger corporation and a smaller, more focused corporation named Coca-Cola. And over to the balance sheets.
Yeah, these are the balance sheets from Pepsi and Coca-Cola, years 2020 or 2018. As you can see, the total current assets, they're slightly higher in Coca-Cola. And as for the total assets, they're slightly higher in Coca-Cola as well. See, Pepsi has a substantial increase in cash from 2019 and 2020, when Coca-Cola has minimal increase. Pepsi has seen a constant increase in accounts to receivables, which total over to 100% of Coca-Cola, while their accounts receivable has decreased from 2019 to 20. Pepsi has also seen a constant increase in fixed assets, which are about double that of Coca-Cola, while fixed assets for Coca-Cola decreased from 19 to 20. Also, Pepsi has much lower numbers of additional paid in capital than Coca-Cola. And the pros of Coca-Cola is that they have more marketable securities than Pepsi, have accumulated less depreciation on assets than Pepsi. Both companies have seen a constant increase in intangible asset balances. Both companies have seen a consistent growth in total assets at similar rates, while Pepsi remains larger. Notes payable decreased by a large margin for Coca-Cola from the years 2018 to 2020. Pepsi has seen increased liabilities year over year relative to Coca-Cola, and long-term debt for both companies is near identical. Coca-Cola has a higher numbers of shareholders' equity than Pepsi. Next slide.
Leo.
These are the statements of cash flows for Pepsi and Coca-Cola. So the cash flows from operating activities, which is cash earned from operating their business, from 2018 to 2020, Pepsi has increased their operating assets. I mean, they earned cash from operating asset activities, while Coca-Cola did well in 2019, but after that decreased in 2020. And then we finally have the cash provided by operating activities. You can see that Coca-Cola and Pepsi's are very similar. And then we have cash flows from investing activities, which is cash spent to grow the business. The Pepsi has spent more cash in trying to grow their business compared to Coca-Cola's. And then we have cash flows from financing activities, which is money raised to help pay for expenses. And as we can see, Coca-Cola has borrowed more debt than compared to Pepsi's. And then to sum all the three of them, Pepsi has a higher sum than Coca-Cola. And then to the next slide. Okay, so cash flows from operating activities has been higher for Pepsi than compared to Coca-Cola. As I previously mentioned, Pepsi has a substantial higher number in common stock compared to Coca-Cola. And overall, Pepsi has more cash provided by financing activities. Pepsi has a higher sum of all three activities. And Coca-Cola saw a positive change in accounts receivable in 2020, while Pepsi was negative. And Pepsi has a higher positive number in accounts payable, while Coca-Cola's was negative. And then long-term debt for both companies is very similar. But Coca-Cola has a higher substantial number in paid in capital in excess of par. And cash flows between Coca-Cola shows that Coca-Cola borrow less money than Pepsi.
Cool. So these are the ratio analysis in regards to Pepsi and Coca-Cola. So we compared the ratios between Pepsi and Coca-Cola. We found that there's much better interest coverage ratio. Pepsi has much better interest coverage ratio by over 9 points. Pepsi has a better quick ratio by 0.77. Pepsi has a substantial return on equity after tax than Coca-Cola, leading by over 50%. Pepsi has a way better asset turnover at 446 over Coca-Cola. Inventory turnover surpasses Coca-Cola by over 43. Pepsi has the higher earnings per share, which in both basic and diluted. Coca-Cola has a better debt ratio by 0.76. Coca-Cola has better debt to equity ratio at 3.10. Coca-Cola has a better current ratio at 1.32, a better cash ratio at 0.59, and higher profit margin by over 23%. Coca-Cola also has a higher return on assets, better receivable turnover, higher gross margin, and higher operating margin. Pretty much these statistics, show that Pepsi does a great job with keeping cash flow high and revenues up, while Coca-Cola has a higher emphasis on profitability as shown in its higher profit margin and higher gross margin. Okay, so these ratios show us that Coca-Cola has better managerial approach to their company than Pepsi. They emphasize higher return and more efficient use of assets. Pepsi emphasizes reducing costs by lower debt and debt to equity ratio, also a higher profit margin. Coca-Cola has much lower operating expenses than Pepsi. So Pepsi has a better stockholders approach versus their competitor Coca-Cola. So Coca-Cola has the better managerial approach, but Pepsi has the better stockholders approach. You can see this due to the emphasis on return on equity surpassing Coca-Cola by over 50%. You guys are able to hear me, right? Just want to make sure. Yeah. You can see this.
For everyone?
Yeah. You can't hear me? No. It's the school Wi-Fi. Can you guys hear me now?
Yeah.
Let me just finish it. So return on. So like I said, Coca-Cola has a better managerial approach, but Pepsi has a better stockholders approach. Pepsi's net fixed assets are also double that of Coca-Cola. The better ESG scores greatly reduces risk of political or consumer action against Pepsi. Higher EPS and lower PE ratio also makes it more appealing to stockholders. Okay, in regards to creditors, right? The ratio analysis shows that both companies have excellent liquidity, a good sign for creditors that debt obligation can easily be met. Assessing the balance sheets and cash flows of both companies would make any creditor eager to loan money out at very low interest rates with little risk to default. Both companies have similar ratios of long-term debt. Pepsi retains higher notes payable due to Coca-Cola's drastic decrease in 2020. Coca-Cola has more stable balances in cash and marketable securities after Pepsi went negative in 2020. And that's it.
That is it.
All right. Yeah, I don't know.